Welcome to a special show about you, about knowing what you can and can't do because it's not right for you. Welcome to a special show about suitability. The first kind of suitability we will discuss is age suitability. I want to start with kids, particularly with infants. Mad Money's been on so long now that there are kids who were born who are in their teens, and if their parents listened to the show when it started, they would already be well on their way towards some great wealth. Parents, grandparents, listen up. You can give all sorts of things to families that had just had babies. I want you to open up accounts for them, or at least give them some shares of stock so that from the earliest moment you can start the process of saving that you have to do. Now, here's my commercial for what everyone seems to have come around to, which is the notion of index funds. We have come through a period where almost all stocks pretty much traded together, and we have seen so many managers been let go or fired because they can't beat the market. So you can take a couple of $100 and buy some shares in an index fund. I'm partial to the Standard & Poor's 500 because those 500 stocks represent the bedrock of the country's publicly traded companies. As a companion, I like any sort of total return fund that has an even broader array of stocks. A mix of both is a very good start. People ask me these all the time. Total return and S&P 500. Your broker or the brokerage site you use might have some fund that is a higher growth, a junior growth fund. That can be a nice augmentation because you are buying for an infant who has his or her whole life ahead of them. These kinds of funds can really compound over time, meaning that if you let it run, the money can build upon itself. Now, you might be saying, why am I watching a show about stocks if all this guy is doing is talk about index funds? I can come in here every night and talk about them, but it wouldn't make for a very interesting show. More important, though, is the kind of investing I am talking about. The comparison we hear about index funds is to actively managed funds. This show is geared to people who are interested in their money and want to be more involved to make it grow, or are curious and want to learn about stocks. I believe that you can build a portfolio yourself that can do better than most managers and funds. But I am perfectly sanguine about the notion that they can coexist. I just wish the proselytizers of index funds weren't such fundamentalists about how bad everything else is. Their lack of flexibility is so stunning. Yet I've had a career of picking stocks better than the market, and I saw so many investors when I worked at Goldman Sachs who would never settle for average and didn't. So I say, let's give both a try. What's a good stock for a kid just born? I think you should pick two. One with a dividend where you can reinvest the dividend and get the power of compounding going for you, meaning that each year a dividend might be increased and you may be able to buy some more stock with that dividend. We often hear the term dividend aristocrats, companies that have long histories, specifically more than 25 years of increasing dividends. I like that. Which ones come to mind that we have liked historically on the show? Well, let's start with 3M and there's Procter & Gamble, Kimberly-Clark, PepsiCo. Any one of them would be great stocks to buy a share of. Then we want something with a little more juice. Okay, I think of FANG when I suggest these. That's Facebook, Amazon, Netflix, and Alphabet, formerly known as Google, hence the G. Why these? I think that Facebook has the ultimate mode about it. It's a rapidly growing site where you provide the content and they provide the ads. It's a brilliant company, deep bench. Amazon? There's a $4 trillion market for retail goods in the world, and Amazon only has a small fraction of it. Netflix? This is a company that wants so much to dominate entertainment with a management that intuitively recognizes what you want when you want it. Game changer. Why do I still like this Alphabet? I mean, isn't that played out? No. It's because it dominates search, which happens to be just the moment you want to buy something, so the advertisers love it. There's a balance sheet of beauty and a whole passel of people working to invent something new to supplant or complement search. Oh, and Waymo may be the ultimate in autonomous driving vehicles. These are just examples. They're about growth. I know that it seems rather commercial to do what I want done here, but I also think that given how poor income growth has been for so many people in this country, it is important to try to augment the other side of the ledger, the savings side. There's no time like the present. One other thought I like. You know, I believe that gold and silver are terrific insurance components to any portfolio. We'll discuss this concept more later in this show. But a highly unusual yet totally blessed by me idea is to buy gold or silver coins for people, or pieces of gold or silver, the actual. I bought slivers of silver for my kids from a dealer and pretty much forgotten about them. They may or may not increase. They are the polar opposites of growth or income stocks. They don't throw off money. They don't do anything. But in crazy times where inflation could come roaring back, there's nothing that holds up in value under that scenario better than mansions, masterpiece art, and precious metals. One caveat. If you do this, remember to put the gold or silver in a safe place. And that does not mean putting it under the mattress or a hole in the ground. A safety deposit box is more my style. Plenty more Mad Money ahead, including more about the most valuable asset in the stock market. Time! The action you need to take today to set yourself or your kids up for financial success. Then they've been the source of some of my greatest investing ideas of all time. You probably got the same resource, but are you paying attention? I'll clue you in. And unfortunately, I don't look anything like how I did in my 20s today. Your money should change with age, too. I'll explain how. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.